A lot of people think it is just credit score, but there's another factor that matters just as much. All right. And that is debt to income. What is DTI or debt to income? I'm sure you've heard about this term here and there. It's a term that a lot of brokers or lenders will use in explaining different things. And sometimes you just don't know what this factor is. So I'm here to explain it to you. Debt to income ratio is simply your monthly debt compared to your monthly income. And it's one of the main ways lenders measure how comfortable your payment will be. Most lenders will look at this as a primary factor in the loan. However, there are a ton of different loan opportunities out there. Working as a broker has opened my eyes to many lenders, many programs, many products. So when it comes down to it, most lenders do require some sort of debt to income ratio requirements. And this can vary from program, from products, different things. Obviously, this is educational only. You want to speak to your lender or broker. I'm here to help improve your thinking process and improve your clarity on these topics. Okay, so we can go over a simple example. Okay. So income is 6,000. We'll say if someone earns 6,000 a month, whether that be from a job, from uh, passive income or non-passive income, Social Security, I'm talking about disability benefits that qualifies to, it could be a variety of different areas where you get your income from. So, say somebody earns 6,000 a month and has 1,800 in debt, and their DTI is about 30% here. So, this helps lenders understand how much room there is for a mortgage payment. How recent does matter. So, knowing how long you've been in the job or how long you've been receiving this income and how long it's going to continue does matter just as well with different products and programs as well. Lenders often want to make sure that this income is going to last. Okay. And for clarity, I am running these numbers on my calculator. So simply 1,800 divided by 6,000 will give you that point 0.3, that 30%. So you can easily go in and compute these numbers yourself. They're very simple to compute and go over a little bit more here. So what counts as debt? When lenders calculate DTI, they look at debts that show up on the credit report and your credit report. These are your monthly payments or your monthly obligations. They are going to look at what counts is car loans, credit cards, student loans, personal loans. With student loans, there are some different opportunities with products and programs where they will use a percentage amount versus that monthly payment. And also, some lenders will also look and pull information with child support and alimony. So be prepared if you do pay those as well, as most likely that will compute with your debt to income. Sometimes different programs allow it, sometimes they don't. It just really depends on the lender, what you're doing, and you always want to ask that person as well. So that's going to be your best bet, asking your broker, your lender to know exactly what is going to count. Okay. All right. What does not count? Things like groceries, gas, utilities, and daycare, they don't show up in debt to income ratio because they are not on your credit report. However, you are very much responsible for these monthly obligations or monthly payments. So these numbers do matter. Gas, water bill, or utilities, phone bills, internet, that is what does not count. Now, I will say this, I have seen these come up in certain loans, mostly veteran with the VA. However, and also FHA as well. So I've seen these come up here and there. Always consult with your broker, your lender, first and foremost, but also you want to do your own due diligence, knowing what your numbers look like on your budget at the end of the month because you're the one who is responsible for paying these bills. And you have to make sure that you have the money from month to month for certain obligations, especially things like daycare. I remember back in, well, when my son was in preschool, the daycare was 750 a month, and that was a huge expense. That was like a car payment or a house payment for some. So, yeah, that it was a big expense, but that needed to happen because obviously we need to work to make the money, and yeah, sometimes it's very expensive. So, and just kind of knowing those numbers is going to really help you and kind of forecast and see. And I'm a big proponent of looking onto the future, looking at future expenses that will come up in 2, 3, 4, 5 years. So that way you know you're secure with everything you have going on and different changes you might have. And I also have borrowers that have changes that benefit them. So, say if the auto loan is going to be paid off in a year or 2 years, that puts them in a much stronger or better position too. So, it kind of just depends on what you have going on at the end of the day and where you're at. We are all on different timelines. So, have different things going on. That's just reality. All right. So now we're going to talk about front end versus back end when it comes to DTI or debt to income ratio. There are actually two types of DTI. Front end looks at your housing payment. So just looking at your housing payment in relation to your income. Back end looks at total picture, so total debt. And as I had mentioned before, it looks at those items that are strictly on the credit report, but looking at your total debt. So your house payment plus the car payment plus your monthly credit card payment or personal loan, things like that. So there are two types of DTI ratios. Products and programs and loans in general are like puzzles. There's many different pieces going on. You got your credit score, you got your debt to income ratio, and then you got your loan to value, which is my favorite one to always talk about, which is equity. And all these pieces play a part into the loan and also different risk factors associated too to make sure that it is going to be successful, you'll always want to consult with your broker or your lender to make sure. It depends on the loan type, as I mentioned, the credit profile and overall scenario. Believe it or not, the home has nuances sometimes that you may not think about, but they do. Just the property type or maybe the position. I'm talking about primary home, secondary home, or investment or rental property. There are all types of products out there, so that's why I always say consult with your lender first and foremost. I'm just here to give you this education as I know it as an experienced mortgage loan originator. Hey, why DTI matters. So DTI or debt to income helps lenders understand risk. They do not want you to default on your mortgage. They tend to be a little bit picky with riskier loans, which is just the reality of it. So different terms will come about on different loans. It always makes me laugh when I have a borrower that wants the lowest interest rate and is shopping and here and there, and then we are able to pull everything together. Just when we do, that debt to income ratio is very high. Risk factors do play a part. That's just the reality of it. So when it comes down to it, just make sure you're checking around, asking so many questions. But riskier loans have different terms. That's just the reality of it. So it's important to know qualifications and how these things work. But more importantly, it determines if your payment will be manageable as well. So knowing where you stand with all your numbers will help in making that decision and making that in a calm manner, not making a quick, hasty decision, just knowing, unless it's going to make sense either way. Um, but other than that, you can take your time and run your own numbers in the meantime beforehand and know where you stand with everything before you even get on the phone with a broker or a lender. Okay. So how to improve DTI, debt to income. If someone wants to improve their chances of qualifying, there are main levers. Main levers, which would be what? Income and debt. So those are the main levers there. And that can improve chances of qualifying and looking at income, seeing if there is a way you can boost that income if you run your own numbers right now and maybe you want to improve things in the next, I'd say 6 months to a year or 2 years from now. You want to improve things. So just knowing what you'll need to do to improve your income. And we are always trying to improve our income, right? Debt. So debt is a huge one where you can absolutely take advantage and pay off what you can pay off. Obviously, it's hard times right now. I know everybody can't afford to pay everything off. I've definitely been there, done that. So looking at debt situations and coming up with some really creative solutions as a broker or lender will help. I have had solutions for clients that just made sense at the time when it comes down to their goals and if it makes sense to pay off a personal loan early or pay off a car loan early just to look and see and if this is all going to make sense. Sometimes it does. So always look at opportunities in different ways that you can improve things or possibly mention this to your broker or lender if it is something that you're thinking about too. So another idea would be to raise income is looking at a co-borrower. You can look at a co-borrower, adding them on. Obviously, you'd want to have somebody that is going to have a stronger income, lesser debt in that scenario. And certain loans will allow non-occupying co-borrowers. There are certain different loans out there that will or will not. It just depends in 2 weeks here. If not, we'll see how things go. All right. Well, thank you for tuning in this evening, and I hope you enjoy the rest of your week here. Bye.